Good morning, everyone. I see we still have people joining and our numbers are increasing, but we'll start with some administrative pieces and then we'll jump right into content. This program jointly offered by Duane Morris and Bates Group does offer CLE credit. There will be polling questions throughout the presentation, 5 total. So if you would like CLE credit, please make sure to respond to the polling questions. There will also be an opportunity to chat with the Q&A if you have questions. We will try to answer them live in the chat or verbally. If we miss your question, we'll follow up with you after the webinar. So today we're going to talk about the future of finance, navigating digital assets in the banking world. I will moderate this panel. I'm Stephanie Waco, a partner at Duane Morris, and I am part of the Duane Morris Digital Assets and Blockchain Group. Also on the panel, we have Brandy Reynolds from Bates Group. She is the Chief Growth Officer and Senior Managing Director at Bates. She has nearly 20 years in AML, fintech, and banking compliance experience. And she's also ACAM certified. She has also helped to redevelop the CAMS audit course, and she is a frequent speaker. Also from Duane Morris, we have Maura Wolf, who is the head of the Duane Morris Digital Assets and Blockchain Group, which supports over 50 attorneys in the practice. He is a former SEC enforcement attorney and a former federal prosecutor with significant experience in securities laws and the SEC and with crypto regulation and compliance. We have Joe Sylvia. He is also in the Duane Morris Digital Assets and Blockchain Group. He sits in our Chicago office. He has experience in M&A, AML, fintech, and regulatory compliance. He is also former counsel at the Federal Reserve Bank of Chicago. And finally, we have Chris Sakala. He is a partner in the Duane Morris New York office as well. And he is also a member of the Digital Assets and Blockchain Group at Duane Morris. And he supports domestic and international clients in matters involving structured finance, capital markets, and private credit. So without further ado, let's move along to our program. Let's start with you, Joe. Is there an opening in the banking world for the crypto community?
The short answer is yes. Thanks for having me. It's great to be with everyone. Yeah, so the short answer is absolutely yes. We've seen kind of a pendulum swing from the first Trump administration where they were interested in crypto, now through the Biden administration, less so interested in crypto and banking coming together, and now a clear mandate for the crypto community writ large, but also with respect to the banking agencies to get more involved with providing what are really traditional banking services to digital asset providers, cryptocurrency companies, and the like.
What do you see as the biggest drivers in this opening for the crypto community?
So some of the biggest drivers are really just opportunity, right? Opportunity to get access to the more traditional financial system, get access to more traditional payment rails, financial institution rails, access to a broader swath of customers. To the extent that I'm a cryptocurrency company or a digital asset provider, and I get to work with a bank or a traditional financial institution, there is some perceived legitimacy to that relationship and to therefore that cryptocurrency company or digital asset because of that link to the traditional financial system.
And as we move forward, and this will probably, intertwine throughout our presentation today, what are some of the biggest obstacles from a high level that you see for the crypto community in the banking world?
Sure. Yeah. So the biggest obstacle is very clearly legislation and regulation. We'll talk a little bit about both of those throughout the time today, but until we get some additional and clear rules of the road, you're still going to have a lot of hesitancy from both the cryptocurrency companies, digital asset providers, and especially the traditional financial institutions with respect to engaging further in this area.
And what a great segue to our next topic, which is what is the current regulatory landscape? And what we're going to talk about here is the state regulation level and the federal regulation level. Morrow and Brandy will guide us through what's going on. I'm sure a lot of you have seen in the news, especially at the federal level, proposals and draft bills. But let's start first, Brandy, with you. On the legislation and regulation, what are the crypto-friendly states? Or who are, I should say?
Yeah, so I think that's a great question because it really depends on several factors and what you think of as being crypto friendly. So, is crypto friendly just the fact that they do have a framework and some guidelines, even though they may be, tough to navigate like New York? Or is it, crypto friendly meaning truly an easy process in the state? So for me, when I look at that question, I think of some of the more favorable states would be the ones with some legislation like Wyoming. So they're, I think probably the most well known for being, crypto friendly. They're known to be a pioneer in the crypto regulations. They have a special purpose depository institution route, SPDI, and they have really more of a clear legal framework for digital assets. So for me, I think most definitely Wyoming tops the list. Also, I note in there Texas, and so while Texas is a state that definitely has high standards for their application process and what they expect for their licensees, but they are known to be supportive. They've had, I think, a great stance for crypto mining legislation. They're being supportive in that regard. Also, some of their tax policies seem to be also very favorable for crypto businesses. The other state that stands out to me would probably be Florida, because they do actively invest in the crypto assets and exploring emerging technologies and strategies for crypto. And they are also one of the states that are looking at Bitcoin reserve opportunities. So I would say, with all that being said, those would probably be the top states that I would say are more or less crypto friendly.
And when you talk about they're crypto friendly and you're focusing on states that do have some sort of regulatory regime, there are others that do not, but could be viewed as crypto friendly. In those states that do, the ones you just listed, Wyoming, Florida, New York, what's the regulatory regime? What is a digital asset or crypto entity going to do? Is it money transmitter, SPDIs, something else? What is the regulatory regime we're looking at?
And I would say that that's part of the problem, is that there are a lot of questions that would really determine that path forward for many of these crypto-based businesses. And I think that's where there's just so much friction still between what do we do and how. And so just to kind of back into that question a little bit more, many blockchain or cryptocurrency-based businesses will find themselves needing an MTL, again, depending upon their business opportunity, right? So it could be that they do have to navigate that state licensing process. And part of the struggle there is that every state is different. With that being said, you have some of the leaders, as you mentioned, New York, that has really set the stage for what that top-notch licensing process and oversight would look like. From there, we've seen some states like California that have started to look very similar to New York, and even offer what is potential fast track, if you will, if you do already have a New York bit license. Some additional states there we didn't mention previously would be Illinois, that also has some pending legislation. You have Louisiana that has specific licensing in place. And so again, the part of the process, the problem is that there are so many different states to navigate. What do we need when, depending upon our business model or our flow of funds. Also, you mentioned Wyoming, which was not just necessarily a money transmitter licensing route, but they also have that special purpose depository institution, or SPDI. It's a mouthful, hard to say, but that's a whole different type of regime, depending, again, what are you intending to do with your business model? So I'll stop there to see if you have any follow-up questions there.
Yeah, so say for instance, you go the MTL route in one specific state, but you want to do business in other states, how does that work?
Yeah, so right now, if you are a money transmitter and you have that touch point where you're looking to truly be a money transmitter, or you have a fiat part of your business, then you're looking at all the different states and what are their requirements for a money transmitter license. Which again, that's where it gets very technical and nuanced, because one state's definition of money transmitter will look different than another state's. And so you unfortunately today have that problem of needing to navigate all those various different requirements.
So right now at the state level, as expected, we have a patchwork, but never fear, we are looking at a proposed federal regulatory framework. And Maura, will you tell us a little bit about the federal regulatory framework that's been proposed, draft legislation, and what's going on with that?
Sure. Thank you, Stephanie. Yeah, so absolutely. So in discussing sort of what the framework looks like, I think one of the things that we do is sort of compare it to what already exists. And I think the best example of what we can anticipate is similar to sort of the blue sky laws for the federal securities context, where you have what Brandy's already talked about, which is the state by state regime. And then sitting on top of that will be the federal. And there are two principal pieces of legislation that we're all following very closely every minute of the day. One is the stablecoin bill, and there are two different bills, but I think the bill that probably draws the most attention is the Genius Act, and that is working its way through Congress as we speak. As of 12 hours ago, 11 hours ago, Brandy, I think there was the logger jam in the Senate has been resolved between the Senate, the Democrats and the Republicans, such that this bill will be moving forward. So we anticipate that a stablecoin bill, which will regulate who the issuers of stablecoins, the only stablecoins will be permitted, as far as I can tell, are U.S.-backed fiat stablecoins on a one-to-one basis. That will be issued at a federal level, or at least you could be regulated at a federal level if you reach a certain size. Otherwise, it could be regulated by state. And then the second piece of legislation is the market structure bill, which is even probably more important, I think, because the market structure bill is going to cover securities, commodities, and sort of safegate stable coins into its own sort of unique position within the market structure. And market structure is really important because it's going to govern at a high level who the regulators are. It's going to authorize the regulators to issue their guidance. We're talking about the principal agencies that issue are going to be the SEC, United States Securities Exchange Commission, commodities, the CFTC, and then Treasury, and all the bank regulators. Each will issue guidance, regulations, and followed by enforcement of those regulations and law. It's going to be quite complicated, I think, initially. And I think, having experts like Brandy and the Bates Group and lawyers like Duane Morris are going to be really important. And we're already seeing this in existing clients, where it's really important to understand, the enactment of the legislation is one thing, right? The problem is that most of the statutes as currently drafted won't become into legal effect for 18 months after it's passed. So you're going to have anywhere from 18 to 24-month window where you're going to have to be prepared. And I think for companies, there's two schools of thought. One is, and what we're seeing now is we're representing clients who already understand that 18 to 24-month window and want to get in on the ground today. And they're asking for strategy with regard to how to get into market today versus those who wait to the end of that 18, 24-month window, where basically my sense, I don't know, Brandy, if you agree, but I think, companies will have to just get in a queue and deal with all the, regulations. And there's going to be, a wave, kind of like standing in line for concert tickets. So one of the decisions I think companies have to make is, anticipating that, do we go in now? How do we go in now? And as you can hear from both Brandy's comments and my comments, one of the challenges is going to be understanding the regulatory framework and the nuance, and making sure that you are in the right place, in the right position at all times, anticipating what's happening today, tomorrow, and 24 months. And that's a tall order, 24 months, 18 months out. But that's what we're seeing in the marketplace. And so that's a really important aspect, is just developing strategy and risk tolerances and risk profiles for the business model.
And I have that, Marcia. One thing that I've seen that I think is unique to point out here is that we have seen a lot of clients ask, is there a possibility for helping to navigate both the legal analysis side as well as the business or the operational compliance perspective? And so that's where, as I mentioned earlier, it's so difficult to navigate what is applicable, what's not, what is your legal requirement. And a consulting firm can't do that. We are not in a position to be able to provide the legal analysis of which framework or how you need to look at the legal analysis. But what we are capable of doing is being able to provide that unique perspective of, now that you know that you're under the purview of the Genius Act, or when that's implemented, or if it's a state regulatory regime, then how do you take your existing business model and adapt it with what you already have in place? And so that is very possible to do that, but also it comes with a lot of challenges and nuances if you're not familiar with the details of those different requirements.
Yeah, and one simple just example, Stephanie, of what we're called to ask, we're being asked to do by clients, is evaluating a product, and whether the product that they're putting together is a security, is a stable coin, or is a commodity. And depending on what they do and how they do it, you could have something as simple as a stable coin, which we know, okay, that's the stable coin, the Genius Act, but it's stable coin plus you marry it with something else, and now you've converted it into a security. And right now, the drafts of the legislation don't really account for that necessarily. And there's going to be gaps, and there's lots of discussions at the SEC primarily as to additional guidance in a variety of areas that we can talk about later, that really go to what Brandy was talking about in terms of nuances. Like, if you don't know that what your product is and where your product fits in the landscape, and whether or not there is or is not regulation compliance or thoughts from the SEC on the subject, you could be walking into a situation where you're inadvertently violating the federal securities laws.
Given that, so let me back up. If there is a digital asset or crypto client that is ready to get started today in the United States and does not want to wait in the ticket line for concerts like we used to do when you would go to like the grocery store or the kiosk and camp out the night before,
Yeah.
sort of advice or approach would you give them to take first steps, given that we don't have a federal regulatory framework at the moment, that it's all being noodled through in legislation at the moment?
Yeah, that's a good question. I think where we start out is we start with the proposition of what the client's big picture business model looks like, their focus. If they're interested in coming into the market, whether it's a stable coin, whether it's a security or commodity, depending on the product, the first stop for us is, okay, is there a state, which is what Brandy covered and why that's so important, is there a state that gets you in the door, right? And one of the unique features of digital assets that everybody knows, but it's worth highlighting, is, look, each one of these markets on balance are billions of dollars globally or trillions of dollars. And so fundamentally, you're talking about international markets. Even if you start in Wyoming, right? Or if you start in Texas or Florida or New York, right? So part of the model that in discussions we're actively having with clients is, look, do you want a national, US national business? And I can't imagine, and we haven't spoken to any really client or very few clients who say, no, we're very comfortable with just being in Illinois, very comfortable being in Texas, right? Because it's just, you're diminishing your market cap and your potential exposure for business worldwide. What we're really talking to clients about is entering the market through Wyoming, right? Going across the entire United States and then expanding that business into Latin America, into Europe, Africa, or Asia. And those are very, very sophisticated conversations. I mean, I think one of the biggest clients that we had like a 6-hour meeting having these discussions of just hearing and digesting the client strategy, which is at 15 different levels. And so that's kind of what we've started to see with clients on different levels. The level of detail and thought. We're talking, Brandy, I don't know what you think, but we've talked to clients that it's like 10, 15, or 5, 6 years of analysis about what they want to do and how to go about doing it.
And just to add to that, from the compliance perspective, when we are engaging in these, for us, it's always ensuring that, again, that there's the legal analysis, but then working with counsel to determine those nuances and what options are available. Some companies that come to us, especially the startups or those that are entering the U.S. market, are very interested in the speed to market, because time is money. Sadly, navigating LTLs or that process is nothing but quick. And so some of the options that could be explored are working with another licensed money transmitter, if that is the business model and the approach. Those are fewer and far between. Likewise, working with a bank sponsorship model. So those are still available, but again, those are very much few and far between as well, just because of the regulatory scrutiny. And so those that are able to obtain bank sponsorship are most definitely well funded, buttoned up. They have proper legal counsel guiding them. They have AML program and all the full works they go along with that. But those are some additional options that we have seen explored as to the how do we get to market while we maybe are obtaining some type of licensing, whether in the U.S. or internationally.
Right. And Brandy, and Stephanie, that sort of touches on sort of the broader, I think, palette of resources a firm of our size offers clients. We have 50 plus lawyers in our group. We have dozens and dozens of connections and relationships that are outside Brandy's area of expertise and our area of expertise, including banking. So we're running into clients or prospective contacts who are white label, who do all kinds of other things, who can white label products. To Brandy's point, that might save time, energy, and resources, but it just really depends on what the end goal, which is why we spend a lot of time with clients understanding their models.
And just let's take 2 minutes just to level set here with the new administration and the proclamations and Trump 2.0, the directives regarding enforcement actions directed towards the crypto community. Brandy or Mauro, would you tell us what that directive is and what you've seen happen? Just maybe 1 or 2 minutes.
Sure, I could go first. Brandy, I think what I would describe it as unprecedented behavior by the government. I refer to it colloquially as the Grand Reset. So basically, nearly every certainly SEC charge that focuses on technical violations such as sale of unregistered securities or operating a securities exchange, all those cases have gone by the wayside, either been voluntarily dismissed or settled. I don't think that's the future. I think it's just a reset to allow the market for the SEC and the Congress to put down clear rules of the road. And then we will see whether or not and to what level of degree enforcement follows. But most assuredly, enforcement will follow, fraud will follow, the good actors by bad actors who are trying to benefit from the goodwill generated by good products and good services. Randy?
And something that we see a lot of times is when you have the SEC who steps back from something, sometimes the states will step in. Is that something, Brandy, that you've seen or anticipated?
Yeah, and so I think there's a couple of different perspectives on this, and one is that you do see or hear some concern with state regulators. But I've worked with state regulators for many years now, probably over 20 years to date myself. And state regulators are good at what they do, and they have always had a focus on consumer compliance. Now, I think this will heighten their concern or their focus, but it's not new for them. So we've always, like I said, you've been, on the assisting side of state regulatory exams, multi-state exams, and there's most definitely a focus on consumer compliance and ensuring that their citizens or whatever state the licensee is in are protected. One thing that I will note was the Coinbase case brought by Washington State Department of Financial Institutions. There were other states that were brought in on that as well. And we are starting to see a lot more of these joint regulatory issues brought by multiple different state agencies coming together. So there, I think a lot of the concern was most definitely on the consumer compliance side. But we've also saw a little bit of the pulling back from some of those states, with Washington, I think, still having some concern in there. So again, I think that we'll see more heightened notice by the states with regard to consumer compliance, and maybe picking up where the CFPB is left off, but it's not new.
Yeah. And that brings me to, so we're on one side of enforcement actions. Another side of enforcement actions that's in the B billions that you see in fines to the crypto community and digital assets community is in AML. And we could spend probably, this webinar could be 4 hours if we allowed it. So for our audience, this is kind of just a teaser on AML. And understanding how AML and BSA fit into the digital asset space with stablecoin legislation. And Joe, will you tell us how and what are some important takeaways with the stablecoin legislation, the draft legislation, and AML?
Sure. Yeah. So as Mauro and Brandy talked about, the legislation that's working its way through Congress is pretty fascinating. And as it relates to AML, as you would expect, there's some pretty serious expectations with respect to compliance programs for AML, and what's considered heightened risks, and what the broad-based expectations are for AML programs, which are very, very similar to what you would see, if not the same, for other kinds of financial institutions on the traditional side. And so it's going to be looking at full scope programs, reporting, transaction monitoring, record keeping, all of the fun stuff that folks are familiar with on the AML side from a more traditional financial institution perspective.
And when you say traditional financial institution perspective, what is typically the quote financial institution?
Sure. So with respect to AML and BSA compliance, when I say traditional financial institution, it's broader than just a bank or a credit union. It's really inclusive of the money services businesses, which includes money transmitters, and includes securities, commodities dealers, entities that are engaged in those markets as well. So it's really very broad based in terms of quote unquote financial institution. And so with the stablecoin legislation, if you're going to be issuing the stablecoins, I would expect that the final result is that you'd be considered a financial institution, if not under a specific one of those umbrellas, at least under the umbrella of a financial institution as under the FinCEN regs. And so that comes with, again, the full suite of expectations, right? So you have the 4 pillars of BSA AML programs. You have the additional layering on of countering the financing of terrorism, CFT types of expectations, which kind of blend into the AML program. Then you have the OFAC sanctions issues to take care of in terms of checking the SDN list and other state lists. So it's really the full suite of expectations for stablecoin issuers, other kinds of cryptocurrency providers, exchangers, administrators, just like FinCEN has talked about for years in terms of expectations for those folks that fall under the money transmitter section of the FinCEN regs. Those are going to be very, very similar, if not the same, or even more robust. As we all know, the first criticism of cryptocurrency or digital assets is that it's simply a way to launder money. And so if that's the initial response that someone provides, then the initial result and justification in response back is, no, we have all these AML obligations, and outside of bad actors and outside of some other nefarious issues, we're doing, and we have the same kind of expectations that your normal bank does, your credit union, your broker dealer, all that kind of stuff.
Yeah. Brandy, Joe alluded to the 4 pillars and an AML program. Will you give just a summary overview what you're seeing in your role for an AML program for digital assets in the crypto community?
Sure. So again, depending upon the business model, what we typically see is two different types of approaches to an AML policy or a program. And so one could be a voluntary AML program where a bank is requiring an AML program, or it could just be a best practice where it's going to look substantially similar to what we would call your traditional or financial institutions, your AML program. Some of the differences may be if you're non-regulated, you can't file suspicious activity reports if you're not registered with FinCEN, and some nuances like that. With that being said, for me, I think one, all the pillars or all the requirements of an AML program are just about as equal as the other one. And so you're looking at your very basic foundation for creating the AML program. It needs to be in writing, needs to be risk-based. You have your internal controls, your training, as well as you have independent testing. So those are going to be the foundations to any program. To kind of back into that in a little bit more detail, some of I think the key areas to focus on are what we really try to work with our clients on, some of the differences or areas of heightened focus. Would one be your risk assessment or assuring that it's risk-based? And so this is where there's a lot of chatter in the industry, one with money services businesses or non-traditional banks being required to have a risk assessment. And so there, aside from do we need to have it from a regulatory perspective or not, the basis is that you can't have a risk-based AML program if you don't understand your risk. And so with that being said, really truly understanding what your AML and OFAC or sanctions risk is, and doing a proper analysis of where your inherent risk to your business model. And so not taking a cookie cutter approach. I downloaded, one from ChatGPT or from Google, but really truly understanding those risks to your business, finding out what would be appropriate mitigating controls, and then understanding your residual risk. And so that is the very foundation and one of the absolute most important pieces to building your compliance program. From there, it's understanding your customer base, and that can look different for different financial institution types. So you may have a full customer identification program, but at the end of the day, you need to know your customer. You need to understand what is normal for your customer, what would be a red flag. I mean, if you have a regulatory reporting obligation, you need to be able to perform the transaction monitoring and report suspicious activity to FinCEN. And so those would be some of the key components there. I'll stop to see if there's anything that Joe or Seth you'd like to add in there, or questions.
There's actually a question from the audience, and I'll read it to you. It goes back to the risk-based approach and risk assessments that you mentioned. And the question is, when it comes to risk tolerance and assessments, should an institution create a separate risk management program for crypto customers and activities? Or should the crypto risk be embedded in the overall risk program, especially at the beginning of banking crypto? How do you recommend the risk is managed separately or together with the rest of the customers and products?
Okay, so to answer this question, I would say, I would look at it from two different perspectives. And at Base Group, we have assisted more than one traditional financial institution learn and appropriately bank crypto. And so what we have guided them in that process is, first, from a very early perspective, the proper approach would be to conduct a risk analysis or a product analysis from the very beginning. So for a financial institution wanting to learn how to, quote, bank crypto, what does it mean for that financial institution? It can look very different. Some may have only a risk tolerance to indirectly bank crypto. So some may want to jump in with 2 feet and offer banking as a service to crypto. So fully understanding what the business requirements are, understanding the product service offerings, the risk from the very beginning. So I would say in that regard, having a very separate, specific risk assessment for the product. From there, I would look to fold it into your AML or your enterprise risk management risk assessment if you have one. So the risk with crypto is going to be very different So it'd be just like adding any additional product or service offering to an AML risk assessment. So adding that as a specific subset of your products or services, and analyzing those specific risks for AML, for also fraud risk and OFAC and sanctions. Lastly, I would say looking at it from a customer risk perspective as well. So again, the ideal approach, and throwing out a lot of information because many different financial institutions are different sizes, different risk tolerance and so forth. But having a proper approach for being able to risk rate your customers is ideal. And so folding in crypto into your customer risk rating would be extremely helpful for understanding the risk of that customer to your financial institution as well. So if they're looking to only engage in, say, crypto for non-individual customers, and then you're realizing that you do have customers that are utilizing crypto services, that would be something that you could look from a specific customer level risk.
Joe, what are you hearing from clients is the toughest aspect of implementing an AML program?
Yeah, I think one, that's a great question. And from the clients that we've talked to and the prospective clients we've talked to, it's less so about drafting the policies and procedures, which they can leverage from other areas of institutions. It's really understanding the reporting and record keeping, and then also really exactly what Brandy just talked about, appreciating this risk-based approach and risk assessments. Like, what does that mean? What do they need to be thinking of? How do they get to the point where they feel, they being the institution, how do they feel comfortable enough and smart enough about what it is that they're actually going to be doing with a cryptocurrency company or a digital asset provider? When do they feel smart enough about the functionality to be able to operationalize that from a compliance perspective, and what does that actually mean internally for the institution? So that seems to be a little bit, it's much more nuanced than just putting together a template policy and procedure, right? It's much more about what are we actually dealing with, and how do we actually assess that risk? Where do we find information on this community, and how do we get smart quickly on it so that we can assess the risk appropriately, and then leverage it for a risk-based approach to the full-blown compliance program, as Brandy mentioned.
Yeah, and Stephanie, just to add to what everyone else has said, I mean, I think one example of a layer of additional complexity is the OFAC and the administration withdrew Tornado Cash from the SDN list from OFAC, which is a software that basically tries to anonymize transactions run through it, a mixer. And so the goal is to anonymize the originating source of an asset that's run through it. And so as that becomes essentially lawful under US law, I think that makes it much more difficult for the AML compliance for banks and financial institutions in the US.
And Brandy, what about from your perspective when you've sat in the chair as an AML chief compliance officer? What has been, I guess, the most important aspect that you've addressed in that position? We've talked about risk-based, it might be same answer stuff.
Yeah, so I would say there's a couple things. So one, I think is probably the foremost would be the buy-in from the board and leadership. So especially when you deal with startup companies or those who are not more accustomed to traditional financial institutions and the requirements and the nuances, then getting the buy-in to understand that you must have these controls in place, and that compliance isn't a cost center or a hindrance or friction to the business. That would probably be the biggest. But then also I would say the lack or inability to understand what tools are needed and necessary, just because of there's just a lack of either information, experience, or education.
So speaking on that, what happens if you don't get buy-in or you don't have the tools necessary? Joe, what are the risks of non-compliance with the AML BSA requirements for
Well,
digital?
Yeah, great question, and something everybody's worried about from the outset. Obviously, we talked a little bit about the enforcement actions, and clearly, civil money penalties are a big one. Um, if you look at any amount of the enforcement actions from FinCEN, OFAC, or any of the banking agencies related to AML more broadly, they're pretty dramatic in many cases. Not only the scope of the enforcement action, but also the penalties assessed. And then in traditional financial institution land, if you get an enforcement action, especially related to BSA or a consumer compliance issue, there's going to be a lot of work on the back end to remediate for that enforcement action. And you're basically going to be in the penalty box for some amount of time, usually counted in a large number of months or even years, depending on the type of enforcement action. So the risk is that you kind of get sidelined from a lot of activity, expansionary activity, new products and services, all those kinds of things for 1 to 2 years, because you're looking at different bank examination cycles, and those are not something that happens overnight. So it's really a real hindrance to business. And there was one question that came in, Steph, I just wanted to look at. It says, given the regulatory uncertainty and enforcement actions, should consumer financial companies treat partnerships with crypto firms as a compliance risk or a competitive necessity? And what will regulators penalize more harshly, inaction or innovation? That's a great question. That is a really great question.
Yeah.
It's hard to say if a regulator would penalize inaction more so than innovation. I think, with inaction, you're just going to stay on the sidelines and you're not going to get your toe wet. So you're not putting out a lot of risk there. With the innovation, yes, you're exposing yourself potentially to additional risk. But again, a classic lawyer response is it depends, right? I mean, it depends on the level of sophistication that exists at the company now, the level of sophistication of the regulatory compliance folks, the third parties and lawyers and consultants and so forth that you work with. And look, from my individual perspective, I don't want to say it's a competitive necessity, but depending on what line of business that you're in, where you stand in relation to your market peers, it may actually be a competitive necessity to start getting involved in this sector, because it's not just banking crypto firms. It's not just providing traditional services to a cryptocurrency fund or something like that. It's the ecosystem is so much more than just a cryptocurrency, right? There's so much more technology, and we're not going to talk about artificial intelligence, so I won't say anything more. But there's so many other aspects to it that at some point, engaging in this ecosystem does become a competitive necessity, even if it's not necessarily with respect to cryptocurrency specifically.
Yeah, and Steph, if I could just jump in on a comment. I mean, I'm one of the lawyers who defends clients who are allegedly in violation of these laws. And what I could tell you is, in response to that specific question, I think the standard that I would use is, are you reasonable? Is your behavior reasonable under the circumstances given your nature of your risk? The big cases that we've seen in the last 3 years, $1 billion fines, are cases where you have actors who are unlicensed, in the context of OKX, for example, as an exchange. It doesn't have money transmitter license. They got a 2-year timeout. In other multi-billion-dollar penalty cases, you're talking about egregious conduct over an extended period of time. Details as to who, what, where, and when is beyond this particular session. But I do think that anything that you can bring to the table to show sort of a cutting edge goodwill attempt to try to do the right thing, in this administration, I think will be treated differently than prior administrations. And that's based on having active cases right now with different sections of the Justice Department. Expanding into the prior administration, the current administration, there is philosophically a change of philosophy, I think. And in fact, I think just recently there was an announcement of the new revised corporate cooperation policy that touches on a presumption of not being charged criminally, for example. Doesn't say what happens with penalties and fines, but presumptively, the idea is that if you cooperate, you try to do the right thing, you stand behind all of the due diligence and the AML policy procedures and actions, and you have a good theory behind what you're trying to accomplish. I think that the current administration appears to be more open to providing greater benefits for those companies. Brandy, I don't know if you have any other thoughts on that.
Yeah, so I don't have a legal hat to put on, but I would say from my compliance perspective that may be a little different, but yet still in line with you guys. I would say that it's both, could be a compliance risk, but also a competitive necessity, meaning that just like whether you onboard from a due diligence perspective a partner, or if it's a client, there's going to be various different types of risk associated with that. There's most definitely going to be the potential for compliance risk, reputational risk, other risks that would be there inherently. But also, most definitely, it would be a potential setback if it's not looked at now. What I think to caution, though, is that it will not look the same for everyone. And so jumping into crypto for some may be very much on the surface of maybe embracing a partnership, or having some very light banking services if you're a traditional financial institution where it's not touching customer funds, as an example. Not everyone has to go into the deep end with onboarding crypto clients, and you don't really understand blockchain analytics, and now you've got this subset of customers nothing about the risk. So again, I think definitely a necessity, but it does come with risk.
Yeah, and just to close out the section we're talking about here, there was another comment about not only board support, but also really giving the AML compliance function the authority that it needs to operate and really effectively mitigate the risk. I think at the end of the day, the more equipped that the institution is, the smarter the institution, the more thoughtful and preparatory the institution is, that is ultimately going to result in a competitive advantage, right? Whether it's specific to crypto or whether it's more broadly with respect to what Chris will talk about in other areas, that creates the competitive advantage going forward, whether you want to try and do that now or in the future. And certainly, again, showing the regulators that you're giving the due authority to AML compliance will help support and mitigate risks associated with enforcement actions, CMPs, and so forth. And so, again, getting smart and doing the diligence now, if that's what you're wanting to do, if you're ready for that, will create a competitive advantage in the future at some point.
So let's shift from the Sunday scaries and let's go into, I want to make sure we cover this topic because it's come up a fair amount recently in the news, is real world asset tokenization. And this is one of the specialties of my colleague, Chris. So let's move away from Sunday scaries and do a 180, and let's talk about real world asset tokenization. Chris, just what does tokenization mean?
Sure. Thanks, Steph. Yeah, and I'll hopefully bring this to a place where you guys are on the business side a little more than the regulatory side. So tokenization itself at its most basic level is the process of converting real world assets and/or financial assets into digital assets, namely tokens that are on the blockchain. The reasons that this is done is for multiple reasons. Obviously, it creates liquidity, but allows for trading, management, and fractionalization of real world assets. The process itself of tokenizing has several components. Basically, the first is, like a lot of other structured finance, is choosing the asset that you want to either fractionalize or tokenize in this case. I'll go through use cases in a little bit, but ultimately you're going to basically pick a real world asset, i.e. real estate and/or private credit loans, something along those lines, or a financial asset that would be ultimately, and then you're going to take it and create a legal structure around it that allows it to be basically sold in fractions, which are the tokens. And then those are basically, we create digital assets from those, which are the tokens, and put them on the chain actually itself. So that's the second. So the first component is really the asset selection, then the legal structure, which ultimately takes a lot of traditional legal components like security, interest, and things along those lines, and also the rights and obligations, and creating an actual ownership right in the actual piece of real world collateral that can be transferred to that token and put on the chain. Once that's done, then basically there's a creation of the token. The creation of the token basically is a mint or creation of the token on the blockchain. And that's going to allow for the fractional ownership. So it's going to allow for purchasers of the tokens or recipients of the tokens, however they gain the tokens, to actually have ownership in the underlying collateral to the extent the amount of the tokens they own or token they own. Ultimately, at this point, also, this is where without getting too far in the details, this is where smart contracts come in. Whereas the smart contracts basically automate the rules that we would normally put into place in a securitization. So you're going to have dividends, transfer rights, things along those lines. So basically, the rights and obligations that go along with your token and your ownership in that real world asset. Next step in sort of the process is really, and this is really done throughout the process, is really making sure that the real world asset itself is custodied appropriately and is actually collateralized appropriately. So ultimately, the creation of a special purpose vehicle, special purpose entity, things you see in structured finance will transfer here. And then ultimately, there's documentation around that to make sure that everything, the collateral that's being fractionalized is actually under the control of in the right places. And there's a whole structure around that we won't get into the details here. Next step would be distribution of the tokens. And this is where again, we're going back to some more of the traditional capital markets functions that banks and financial institutions would play in terms of being underwriters, how they're going to be distributed. Is it going to be through a private placement, a public offering? And that's going to depend on regulation. It's going to depend on the target audience for the token. It's going to depend on the size of the offering. All the same analysis that you see in traditional capital markets transactions are going to apply here. So that's one thing. And then there's always secondary market trading, which is a big benefit to tokenization. That's not required, obviously. And it's going to have exactly the same analysis, or maybe slightly different, but the same analysis that you're going to see in a capital markets transactions. If it's permitted, you're going to see DeFi protocols put in place and things along those lines. So it's very important to look to engage capital markets counsel and capital markets advisors throughout the process. And that's where it should be treated like any other capital markets transactions or a secured structured transaction, ultimately making sure that all of the sort of exemptions necessary and or registrations necessary happen. Because as my colleagues just talked about, the regulators are going to be looking very much in the same places for the same thing. So sort of a common thesis, I think, throughout this is that a lot of traditional rule, regulation, enforcement, and approaches are being applied to just a different asset class. And I think when we break it down that way, we take away some of the mystery around it. And yeah, we can, and then real tokenization of RWA tokenization is probably one of the easiest places if you have to explain it to someone to really show how it works, especially with something like a real estate asset. Why do banks want to engage in this? There's a lot of reasons. I mean, that I see clients when I talk to clients why they're looking to engage. I mean, the most obvious reason is liquidity. Obviously, this creates liquidity like most other structured finance products. But there are efficiencies this creates as well in terms of back office and paperwork. There's transparency because you have immediate ability to audit these things and much more and trace them and because they're on the chain at that point. And then one thing that we talk a lot about, I do a lot in my practice in New York and Miami, is represent international clients. And we talk a lot about the fact that crypto is in nature, digital assets by their nature are borderless. Obviously, tokenizing something even takes away some of the friction that you have. So ultimately, it helps with cross-border transactions and takes away a lot of that friction. And then also the smart contracts themselves, the programmability that help the tokens, they actually can automate a lot of the rules and regulations. So not that everyone's trying to automate away any of the right programs and oversight and enforcement, but it certainly can enhance that.
What are you seeing as and I hate to use the word real world use cases, but what are you seeing as the real world use cases for real world asset tokenization? And you mentioned real estate. I got 3 reels in one question.
That might be a record.
I like it. Obviously, and again, if we're going through the most vanilla sort of, if there is such a thing as vanilla, I would equate this with commercial mortgage-backed securities. We're seeing tokenization of real estate assets. Real world real estate assets that are basically getting tokenized and put on the chain. So it's allowing fractional ownership in largely commercial properties. We're not seeing this in residential properties or portfolios of real properties. And they're secured very much in the same way as you would on a commercial mortgage-backed security offering. The tokens themselves represent ownership in the income stream derived from those assets. They can represent ownership in the asset itself, depending on how you structure it. The other place we're seeing a lot of action these days, and I think you're going to see a lot more of it, again, that's just my prediction here, is private credit. We're seeing a lot of loans and debt instruments being tokenized and put on the chain that way. So ultimately, it's sort of a back end form of syndication, for lack of a better term. It's basically a CLO, collateralized loan obligation, where ultimately what we're doing is these loans are out there, they're originated already, they're largely held by one or two private credit funds, and then they're being basically tokenized and then being sold off in chunks. Right now, most of what we're seeing is it's institutional in nature. We're not seeing private. I'm not seeing private credit loans really trickle down to individual investors. We've seen we've seen it go down as far as some larger family offices, but I have not personally seen a lot of individual investment yet. But I think that's just a function of where we are at the moment. The other place, and this is where I spend a lot of my time working in the real world, is trade finance. And I think trade finance, I can talk for an hour on this, is probably a place where tokenization and cryptocurrency or digital asset in general can help substantially, because there's just the whole process of trade finance in terms of the way things move, how they're done, needs to be somewhat frictionless, and relying on 300-year-old sort of letters of credit and things along those lines are not necessarily keeping up with time. So we're seeing in trade finance, we're seeing tokenization involving letters of credit, we're seeing tokenization involving receivables, invoices, and there's going to be a whole host of things in trade fi that goes forward with forfeiting and bills of exchange. And it's just at this point, from my end, it's a matter of regulation keeping up with this. Other places where we're seeing some of it in other real world use cases are hard commodities like gold, where the asset's physical custodied and then there's being fractional shares sold off of that. That makes a lot of sense for a lot of reasons. And then finally, with government securities, with treasuries and bonds, we're seeing them tokenized. Largely in those cases, why I'm seeing it happen is because the settlement can happen faster.
Mhm.
Those are the major cases, but I think there's going to be a lot of creative uses of tokenization, and a lot more assets are going to be, tokenized.
And on the flip side, will you talk a little bit about the use cases for collateralization with digital assets?
Yeah, sure. So this is the other side of the coin, right? So tokenization is ultimately taking real world assets, breaking them up, putting them onto the chain, creating digital assets in the form of tokens. This would be ultimately using, native digital assets and how they can be used as collateral to borrow against. And basically, the sort of main structure would be that the digital assets themselves, normally it's BTC at this point, or wrapped BTC or something along those lines, can be properly collateralized so that a borrower can borrow actual fiat currency against it, and or stablecoin, right? So stablecoin can be the actual proceeds of the loan. It doesn't need to be, because the stablecoin itself has its own backing. So you can take a BTC loan, collateralize the BTC, and then issue, USDC against it or something along those lines. Or you can issue fiat currency, which is, the more traditional way to do it. The other places where we're seeing some of that happening are some derivatives contracts are coming off of that, where the actual underlying digital assets need to be put in place so that there can be derivative contracts written. And then there can be other assets. Obviously, BTC can be wrapped in other things, and we can work from there. So those are the cases we're largely seeing. Again, the reason for this, like most structured finance and most lending you guys do, is liquidity. It's ultimately there's a situation where you have someone who's holding a fair amount of digital assets, and liquidity can go in stages, right? It can be basically BTC getting to Ethereum, or BTC being used as collateral to get to actual cash or stablecoin along the way. Things that can actually be turned into more liquid assets. And I think that there's with those use cases, I think what we're seeing more and more is that there are the metrics being used are traditional metrics, loan to value ratios being the most common one, especially in centralized finance. You're seeing the LTV is, and then that's one of the challenges as well.
So today we've talked about market opportunity. We've talked about proposed legislation, AML programs and the Sunday scaries, and real world asset tokenization. We've got 1 minute remaining. Mauro, Brandy, do you each want to give us your takeaways from our last 59 minutes from today as your parting advice to our audience?
Brandy, you can go first.
Thank you. So my parting advice would be, look at what you can do now. So take the opportunity when there's legislation pending, maybe some new frameworks, some guidelines. If you have ever been interested in dipping your toe into crypto or stable coins, because we are seeing a lot of use cases with everything from cross-border payments and everything we've talked about here today. So I'd say now's the time to take advantage if you've been interested in the space.
Yeah, and just to follow up on Brandy's point, I mean, I think there are areas where the opportunity is golden for those who are willing to take the appropriate risk and measured risk. And I think planning and strategy is critically important at this stage. And there are areas that are really uncharted waters, like staking, decentralized finance, and lending. Don't know if they're securities, not securities, whether the SEC is going to do something, regulate them, not regulate them. So we're all sort of ahead of the curve on that, understanding where this is going, and we could be there to help sort of set the table and guide you through this otherwise fairly complicated and nuanced area.
Thank you, Mauro, Brandy, Chris, and Joe, and thank you to our audience today for joining us. And we hope that you enjoyed our presentation.
Thank you, everyone.